Good evening, friends. Hope you all are well and doing fine. I, Ashok Kanawala, part of products team, on behalf of HDFC Mutual Fund, extend a warm welcome to all of you to discuss a simple but very interesting investment opportunity, HDFC developed World Indexes Fund of Fund, our first international offering and one of its kind. With me is my colleague Ram Kumar, who is a co-host for this session. Today, we have two special guests with us, Navneet Vinod, our MD and CEO. Navneet is an industry veteran with an industry experience of over 25 years, and most of you know him or would have engaged with him in past. Welcome, Navneet. We also have Mike Levin from Credit Suisse, US. Good morning to you, Mike. You are out of US.
Good morning.
Mike is a managing director and head of asset management business in America and Asia Pacific for Credit Suisse. He is responsible for operating business in America across the range of investment capabilities and client coverage. In Asia Pacific, Mike develops and directs the regional asset management strategy, including distribution, product, and partnerships. He also works closely with institutions and private banks in delivering asset management investment solutions. He brings over 25 years of experience in asset management industry. And of course, we also have his colleague, Ashish Jain, on the call. And Ashish is a director and head of products based out of Singapore, in charge of its products part in the Asia Pacific ex-Japan. So without much ado, I now invite Navneet to give his opening remarks. Over to you, Navneet.
Thank you, Ashok. Good evening. Thank you for joining this call. At the outset, I take this opportunity to thank each one of you for your support to SDFC AMC. It was exactly 21 years back when SDFC AMC launched its first three schemes. If I remember correctly, the allotment date was 11 September 2000. Of course, some of the funds have even longer track record due to our acquisitions. We have come a long way since then, serving millions of investors with over 90 lakh folios and close to 4.5 lakh crores in AUM across asset classes. I take this opportunity to thank each one of you from the bottom of my heart for all your guidance, your encouragement, and support to SDFC AMC over the years. I stand here today as part of an industry that has done extremely well thanks to all of you, our partners. While the COVID crisis brought unprecedented challenges, our industry not only displayed huge resilience, but also worked with a greater resolve to serve clients better. I salute MF distributors and advisors for their heroic work in these challenging times. As someone rightly said, no crisis should be allowed to go waste. I think together we as an industry have upped our game in all aspects, including leveraging the power of technology to serve our customers better. And thanks to our efforts, the industry AUM has gone from less than 10 lakh crores or so in 2014 to over 35 lakh crores in 2021. That's 3.5 times growth in 7 years. In fact, it would have doubled in last 5 years. More interestingly, equity AUM has gone up almost 7 or 8 times in last 8 years or so, with increasing retail participation. The concept of SIP is gathering momentum with monthly flows almost nearing 10,000 crores. They're almost there, very close to 10,000 crores now. And industry has also touched a new milestone of 10 crore folios. These are really big milestones. While we all take pride in the numbers that I just talked about, but I get reminded of Robert Frost, who said, "Woods are lovely, dark and deep, but I have promises to keep and miles to go before I sleep." We must keep in mind, we still have only 2.5 crore investors in mutual fund industry in India, if you look at unique pen. With that in mind, on the momentous occasion of 75th anniversary of India's Independence Day, we at SDFC AMC launched an ambitious investor education campaign. You would have seen that, Barni Se Azadi. This campaign is part of our mission to be the wealth creator for every Indian. I'm sure together with the active participation and support of all stakeholders, we will take the message of mutual funds sahi hai to every single household in India and take our industry to newer highs. The next wave of growth will not only see new MF investors, but also an overall smarter investor base, a smarter mutual fund investor base, if I can say. And this growth won't come unchallenged though. These same new investors we are targeting are also getting trigger happy on buying stocks directly. The 3 years up to March 2020 saw, if I remember correctly, around 70-75% growth in mutual fund clients versus a growth of 47% in Demat accounts. But this trend has reversed since March 2020. Maybe the combined effect of lockdown, a bull market, technological changes in some of the apps that have come to the in the market and all of that. The number of Demat accounts over the last 15-17 months have grown by over 50%, while mutual fund clients have increased only by 15%. Now, there are two ways to look at this trend, but I would look at this trend as an opportunity for our industry because it reflects a rising interest in capital market products. And we as an industry together need to respond rightly to nudge these investors towards professional fund management. And we need to respond through faster digital adoption, best-in-class servicing, deeper focus on investor education, redesign product and marketing strategies, right partnerships, better connectivity, so on and so forth. But most important of all, we need to continue to keep the customer at the center. Most of these direct stock investors would be feeling great looking at their stocks go up, the way their stocks may have gone up in recent times, while keeping asset allocation and diversification only in the back of their minds. Markets, of course, as we know, are anything but easy to navigate. Many of these investors will eventually find the appeal in the disciplined and risk-mitigated manner of investing through mutual funds. They will find appeal in the sound investment advice from trusted friends such as yourselves. They will find appeal in our principle of what we call STP. Wealth creation means, or wealth creation can only happen through sound investment plus time plus patience. That's equal to wealth creation. Something we have been on a mission to convey to the masses. Just as an example, as you know, an SIP of rupees 10,000 rupee per month since inception in SDFC FlexiCap Fund would amount to over 9 crore rupees today. How much more appeal is needed for new customers to pick mutual funds as their go-to savings platform? We've been increasing our product bouquet in the recent past. Our goal has been to offer the best-in-class products within each category. You would have seen over the last year, in December last year, we launched the SDFC Dividend Yield Fund. Then we launched the SDFC Asset Allocator Fund of Fund. This was followed up with the SDFC Banking and Financial Services BFSI Fund. And most recently, our first smart beta fund, the SDFC Nifty 50 Equal Weight Index Fund. My sincere thanks to each one of you for your support to these funds. The COVID crisis has also brought to the fore an important aspect in investing, something that you all have always been advocating for, and that is the importance of asset allocation and diversification. As the legendary Nobel laureate Harry Markowitz said, diversification is the only free lunch available in investing. And I'm sure Mike would agree to that. With that in mind, we are now glad to launch our first international offering, SDFC Developed World Indexes Fund of Funds, the first of its kind. Leveraging on our long-standing association with Credit Suisse Asset Management, one of the world's leading global asset manager, we offer this unique scheme from SDFC MF. The scheme will invest in Credit Suisse index funds or ETFs, which in aggregate will track the performance of MSCI World Index. So as the name suggests, there are three components to the offering. Firstly, it is a fund of fund scheme. So we will be investing in funds and not investing directly in equities. Second, the underlying funds are index funds and or ETFs, and hence passive investing and not active investing. And thirdly, or lastly, the investment universe for such index funds and ETFs is countries forming part of developed markets, and hence emerging and frontier countries are excluded. Now the question arises, why invest beyond domestic frontiers? And while investing globally, why developed markets? So why invest beyond domestic frontiers? The big question that we are trying to address through this fund is what are the reasons that one needs to invest beyond the domestic markets? And the reasons to go global include a geo-diversification across economies and markets, because most of our investments, if not all, are invested in India. And we strongly feel that asset allocation across geographies is also important. And we clearly see these 5 reasons: geographical diversification, benefiting from global growth opportunities. These markets or these funds will have low correlation across markets to manage risk. We also hedge against the possibility of currency depreciation. And of course, there are a lot of global themes that one can play through these funds, which may or may not be available in Indian markets. So the first point, taking off to the developed markets, as you can see, this fund would be investing through these ETFs and index funds in 5 regions, 23 countries, and all of those are developed countries, across 14 currencies, over 1,500 underlying constituents. And these funds put together would be covering 56% of the, roughly 56% of the global GDP and over 50% of the global market cap. And of course, this will, I mean, you can clearly see that the amount of global GDP and the amount of global market cap that gets covered by investing in just one single fund, and you are investing in the 1,500 high quality stocks across all developed markets. On the next slide, as you can see, if you look at the overall allocation of this fund, US is almost 67-68%. And it might sound on the first glance that the index is dependent only on US. Yes, it is dependent on US from a market perspective. But if you look at the revenues, then it is much more diversified across regions that you can clearly see. In fact, one of the most interesting aspects of the underlying funds is that the sectoral diversification that I would definitely like to highlight. As you can see, the largest sector is technology, IT, and that's 22%, while the second largest is healthcare at 13%. So it's an extremely diversified in terms of sector allocation. The next slide gives the GDP growth of countries forming part of MSCI World Index. And of course, as you know, growth is an important factor for every investor in the equity market. In fact, as per IMF, the GDP of these 23 countries is expected to grow from $47 trillion to $64 trillion over the next 5 or 6 years. So we're talking about $17 trillion of absolute growth in GDP, still nearly 6 times size of India. And should one not look at participating in this growth? Definitely yes. On the next slide, what we are trying to show here is that in terms of markets, how has this particular index performed over the last 1, 3, 5, and 10 years? As you can see across these time periods, average rolling returns in rupee terms has been around 10%. Median returns actually a bit higher, and it has delivered positive returns 97% of the times in 5-year period and 100% of the times if we expand further to 10 years. The negative returns were observed in periods which covered the global financial crisis of 2008. Now, of course, everybody looks at risk-adjusted returns, and that's quite critical. So if you look at, these are the returns which are dollar returns as of end July. And as you can see, markets globally, of course, have done quite well over the last several quarters. And this is what is being reflected in this. The interesting thing that we would like to point out is basically the volatility of MSCI World, the standard deviation of MSCI World versus Nifty 50, our own India's flagship index. as you can clearly see, the volatility of MSCI World Index is much lower than that of Nifty across all time periods. The another thing, as I said, of Harry Markowitz, diversification is the only free lunch available in investing. These markets have a substantially lower correlation with our domestic market. So if you look at last 3, 5, 10, 20 years and look at the correlation between our market, domestic market, and the underlying these indices, they are very, very low. It's somewhere around 0.4. So clear advantage in terms of diversifying a part of your capital towards a fund like this. Now, this slide, what we're trying to show is calendar year returns of both MSCI World on one side and Nifty 50 on the other side. Again, I mean to look at the benefit of the diversification, and which comes out very, very clearly. Because you can see, if I look at a year like 2011, when Nifty fell by 35%, and in that year, the MSCI World was down 5.5%. And in 2007, when Nifty delivered 76%, MSCI World went up by only 9%. So clearly there is benefit of diversification. Now, I talked about the currency diversification as well earlier. And through this fund, you get exposure to almost 14 different currencies. And that definitely help you in hedging against the possibility of rupee depreciation. In fact, if you look at the 5 key currencies, which account for roughly 92% of the MSCI World exposure, rupee has depreciated in the range of 2 to 3% per annum over a long period of time. In fact, in simplistic terms, to keep it very simple, it basically adds 2 to 3% returns in the rupee terms. And these days, as we all know, we spend fair amount of money on international vacation or maybe a kid education. So definitely currency hedge plays a role in our overall scheme of things. On the next slide, as I mentioned earlier, one of the interesting aspects of the fund is that you not only get exposure to companies which are the largest or some of the biggest in the world, but also some of the most innovative companies. This is by BCG, where they have selected the most innovative companies in 2021. This has been selected from a group of like 2,500 odd companies. This index captures 40 out of the top 50 most innovative companies in the world. And of course, we all know several of these names. We are all consumers of, say, Apple, or for that matter, Google powered devices, and several of these kind of stocks are not available to invest in a market like India. In fact, something like AstraZeneca, I can see, which is the license holder of Covishield vaccine. Of course, we all shop from Zara. So this fund would give access to all of these companies and themes which are not listed in India. So to recap, I mean, through these funds and through the underlying schemes, it will access 5 regions and 23 countries. We diversify to mitigate against the single country risk. All our investments are in India. We participate in the growth of the developed markets, and I showed you that graph of the growth that these markets can have over the next couple of years. You invest in 1,500 plus global heavyweights, which overall captures around 50% of global market cap and 56% of global GDP. And of course, you hedge against the currency depreciation. Now, I must mention this, may sound a little immodest, but we have worked very hard to bring this fund to you. And it has taken a lot of groundwork, such as ensuring compliance across multiple jurisdictions, setting up platforms and partnerships to enable optimum execution, and ensuring efficient tracking with minimal transaction costs. Our idea was to get an exposure to these best companies, or to the 1,500 top companies in the world at the least possible cost. And I'm sure Mike will talk a little bit about that. So we have done the hard work, so you don't have to. So just imagine investing in these 1,500 global stocks across 23 countries at such low cost without such a fund. It would entail opening several demat accounts, several broking accounts, a multitude of other administrative accounts, paying various fees and brokerages in multiple currencies, including a variety of taxes in different parts of the world, and staying awake 24 hours a day to participate across time zones. Instead, just invest in this one scheme and you get possibly the best solution as far as global diversification is concerned. So on that note, once again, I would like to thank each and every one of you for your unending support to us. When you think of HDFC Mutual Fund, I sincerely hope you think of trust, you think of stability, and you think of longevity. We want to offer nothing but the best with uncompromised standards in investment management and client centricity. And it's indeed a great pleasure to have my friend Mike Levin, very early morning in his place, MD of Credit Suisse Asset Management, on this call. And I'm really looking forward to Mike's views and looking forward to your questions, comments, feedback. Thank you so much. Ram, back to you.
Thanks, Navneet. That was an extensive coverage of the offering that thanks to you, you covered a lot of points. Now, before we give the floor to Mike Levin, I just want to ask him to begin by asking him to give an overview of Credit Suisse Asset Management and its capabilities when it comes to managing assets across the globe under both active and passive strategies to start with.
Thanks, Ram. And thank you for having me and inviting me to join this event, Navneet and HDFC AMC. I don't think I'll be as poetic as Navneet, but I am certainly a student of Harry Markowitz, who's the founding father of modern portfolio theory. And I think he won a Nobel Prize in economics for that. And there was a paper in 1952 called Portfolio Selection. So very relevant to what we're talking today. And actually, it was interesting, Navneet, you were talking about the lower correlation and the benefits of diversification. And part of that is to gain the benefits of compounding by reducing the volatility and drawdowns. And I think that's part of the premise of the investment solution we're talking about today. And Einstein said, I wasn't planning to mention it, but one of my favorite quotes, he said, the power of compounding is the eighth wonder of the world. And so that's really our objective. So it also feels like, Ram, before I get into Credit Suisse, it feels like a bit of a juxtaposition for me to be speaking to you about developed markets and MSCI World, because HDFC Asset Management has been an incredible partner to Credit Suisse over the past 10 years. And most of the meetings related to HDFC that I've had have been with international investors where we're talking about 4 decades of structural consistent growth in India, really enviable demographic profile, domestic consumption story, making India a critical investment destination for a globally diversified portfolio. So sort of the inverse of that. And I also happen to believe that HDFC is the best active asset manager in India. And I see the ability to add substantial value in relatively inefficient markets over time. And it's really for that same reason, I would say, because of the inherent domestic bias of investors, that I'm here today to talk about the importance of investors in India to allocate outside of your borders, particularly to developed market equities, in order to really enhance that, we'll quote sort of Markowitz against, but that portfolio efficiency and diversify the idiosyncratic risk of any single country, particularly where your career, business, and investments are already concentrated. So we're delighted to partner with HDFC to help you gain access across developed markets in a really, again, this goes to what Navneet said, I think the keys are you want to be cost effective, liquid, and for us, transparent, to know exactly what you're getting. And I've been impressed by the thoughtfulness of HDFC's design, which Navneet talked about, and in particular, just that investment solution on behalf of clients. So perhaps it would be helpful, Ram, I'll extend it. I'll cover maybe 4 pillars that I think capture your approach. And obviously the first one would be, Credit Suisse as a partner and why we're suitable. Second, I want to share my views on MSCI World as an appropriate index for this type of exposure. And I also think it's important. So maybe thirdly, I'll go into questions that arise most frequently for me about the current environment, valuations, and timing. And I know it's on everyone's mind. And then also really to touch on that element of, active versus passive. So Credit Suisse, Ram, to your point, Credit Suisse Asset Management, we're really focused on delivering market-leading specialist capabilities covering both passive and active investment strategies on a global basis. We manage about $500 billion on behalf of clients. And we try really to bifurcate our offerings into that sort of the most efficient passive solutions on one side and highly differentiated, actively managed traditional and alternative investments on the other. So our passive business, which we're talking about today, has really thrived with AUM increasing by over 50% in the past 2 years alone, to about June 30th, which is sort of the last reported date, over 180 billion AUM. And passive it's a particularly competitive business, and you only grow that quickly by delivering value to clients. And so our track record across indexed equities, bonds, and balanced portfolios goes back over 25 years. We offer a suite of ETFs, but we're really a leader in index fund market, where I would say our clients have the certainty of buying and selling the fund at the actual NAV on a daily basis without the bid-ask spread and liquidity issues posed by some ETF. So with that, maybe I'll shift. Ram, is it okay if I just go ahead?
Yeah, absolutely fine.
Yeah, no, because I want to talk about the second point, which is really the relevance of MSCI World to global investors, and particularly in this case to investors in India. So, stepping back, and we'll stick with the theme of modern portfolio theory, like a classic balanced asset allocation strategy would typically or traditionally entail, let's say, a 60% allocation to equities and 40% to fixed income. And equities obviously offer that upside participation in economic growth and a higher expected return, with the fixed income portion meant to deliver steady yield and really dampen short-term volatility. And so with this construct, developed market equities would typically represent the largest share of a portfolio in order to really best participate in that global GDP, market cap, and revenues. And so the challenge, which was touched on a little bit, but the challenge is gaining exposure to a diversified portfolio of developed market equities across regions, countries, sectors, and companies. And for me, MSCI World is really a natural core building block of a globally diversified portfolio or asset allocation strategy. And Navneet touched on the numbers, but I'll just repeat them because they're really important, which is, to gain access or cover over 1,500 companies that comprise roughly 85% of the market cap in these 23 developed market countries in all sectors, with that single low-cost liquid investment solution, it's quite powerful. So one of the things we also didn't really touch on, but I think is important, is that MSCI World is a market cap weighted index. And that means that the larger the market capitalization of a company or a sector, the larger the representation in the index. And it's really an objective way of capturing these massive economic trends that we're experiencing. And that's reflected in the growth of earnings and obviously market cap of the most successful companies. And that's really the reason why information technology is the largest sector, over 22%, as Navneet mentioned, and also the US is the largest country exposure. So the composition of MSCI World is really consistent with that relative market cap of information technology in the US in a global context. And actually their representation has increased, but that's highly correlated with the significant growth in corporate earnings that we've seen in technology, and the United States really delivering the strongest profit growth among any developed market countries over the past decade. And so while many sectors and countries have really struggled over the past decade, you don't really see it in MSCI World because of that diversification and the performance, which Navneet mentioned. I think when you go back over 20 years, you're really talking about starting in the recession and market downturn in 2001. And so that compounded return, I think in dollar terms, would be about 7% over a 20-year, very rocky period that included the 2001, 2002, 2003 obviously 2007, 2008, March 2020, and you're still getting that power of compounding we talked about. So at the same time, maybe talking about the market cap weighted index, because I love this stuff, but not only is it diversified, but it's adaptive, which is that it offers more stability in return profile when there's a rotation of factors like value versus growth. And that's the reason you don't just say, oh, I'll be in information technology, I'll be in the US, which is that things can change, and they can change across sectors and geographies. And we have recent examples. So for instance, after years of underperformance of value-oriented stocks, they've actually substantially outperformed growth stocks in the first half of the year. And likewise, you had the top performing sectors in the S&P 500 this year, which people wouldn't realize are actually financials and energy. So that's the reason that you don't really want to invest just in one sector or just in one country. And MSCI really offers those benefits of the diversification. And that brings me to the third point, which is on every investor's mind, which is, where do we invest now, or is now a good time? And I guess maybe I'll start by disappointing everyone that the more experience I have, the more I realize that I don't have the ability to time markets, particularly in the short term, and that it's more valuable to derive the returns from a sensible asset allocation strategy that incorporates relative valuations where you don't have to worry about that timing. And that tends to outperform almost without exception. And so for me, where we are today with rates and credit spreads near record lows, the fixed income portion of the portfolios, particularly in developed markets, I think is where investors will struggle to make a reasonable return relative to risk. There's roughly $15 trillion of government debt with a negative yield. And that basically means that investors are paying to lend money. So rather than the risk-free return, I like to call it return-free risk. So even if you look at peripheral European countries, you have 10-year government bonds in Portugal yielding 0.2%. In Spain, it's about 0.3%. In Greece, which was nearly bankrupt 10 years ago, it's 0.7273%. And so while equities are not cheap, there are a number of factors, including strong corporate profit growth, really healthy consumer spending, and importantly, accommodative monetary policy that support, and I believe will support, the ongoing allocation to developed market equities. And so when I talk about valuation, if you look at the MSCI World's dividend yield, which we didn't touch on, it's about like 1.66, 1.65% at the end of August. That's already above what you can get from the 10-year US Treasury yield, which is more attractive at about 1.28%. And then when I look at the forward price to earnings ratio, which is about 20, that still translates, when you flip it and you look at earnings as a percent of price, the earnings yield is about 5% looking forward. And these companies are growing strongly. And there's really no basis to assume that growth, even as it slows, won't persist. So while valuations are above historic averages, it needs to be put into context. And I think it's very hard to come up with a case where you won't be able to maintain the underlying drivers of that, which is really earnings and earnings growth. So we all worry about markets when they've risen this much, and that's really healthy. I mean, the saying is, markets climb a wall of worry. And it's a question as to whether current valuations are supported by the fundamentals of earnings growth, economic conditions, relative investment valuations, and also the outlook. And so market performance over the past 18 years has surprised, 18 months, apologies, has surprised most of us. while the early stages of the rally, I would say, are attributable to this extraordinary monetary intervention by central banks around the globe, really on a nearly synchronized basis. So to put in context, the global economic stimulus in just 2 months was in excess of $10 trillion. Now, that's far greater than the GFC. And countries like Germany, France, UK, Japan, the amounts that of stimulus were nearly 10 times the global financial crisis. So while we had this sort of suspension of economic activity in some sectors from the COVID lockdowns, there's no structural financial market, economic, or even geopolitical issue. And that monetary stimulus has been a really important catalyst at the outset, but the performance is sustained by strong consumer spending, which I talked about, the really robust corporate profits. And now what we're seeing, and I think will propel forward, is the fiscal support measures, which are more structural, which are coming in. And so we talked about the US being the largest country in the MSCI world. So, take a deeper look, which is, I'm here, obviously, the strength of the US consumer and the US economy is what has promoted that equity market performance over time. And I'll just use the recent earnings. So Q2 earnings, the S&P 500 had 85% of companies beating already elevated earnings expectations. And overall 2021 earnings, corporate earnings, are expected to be up over 40% in 2021. So the economy is healthy. Real GDP in the US is expected to be around 6% this year. And obviously that follows around a 3.5% contraction last year. But this will allow the US to retake the crown from China as the largest economic contributor to global growth in 2021. And again, talking about diversification, so that's sort of the US side, but there's also the potential that we see a re-rating of European, UK, and Japanese equity markets that would support the MSCI world. So, that rotation is in the cards. And I think in particular, because you had that massive disproportionate economic support in these markets, but you've had a slower reopening. And so it hasn't yet translated into the same earnings growth power that we saw in the US that I believe can drive markets further in Europe and in Japan and the UK. And I think that's one of the reasons that you have the allocation. And so while markets may be volatile and a correction would not be unusual in this type of environment, the fundamentals and the economic conditions are still supportive of equity markets. Wage growth is strong at around 4.3%. Savings rates are really high, and that's sort of spring-loaded potential spending. You have inflation is showing some pricing power for corporates and enabled them to maintain profit margins. But you're also going to see supply chain disruptions easing, which will allow goods to be delivered to consumers. And one of the things that we've overlooked a little bit, we think about the iPhone 13 that just came out, but the opening of economies is reviving the service sectors that actually underperform. So it'll be a little bit of stop and start, but there's a lot of supportive elements that will drive the momentum going forward. I think it's reasonable to think that both growth and inflation will moderate following the recent sharp rebound. You could see some Fed tapering in bond purchases, and that could lead to firm rates. But it's very well telegraphed, and broader monetary policy remains incredibly accommodative by any standard. And it was touched on a little bit about never waste a good crisis, but the acceleration of trends in technology adoption and healthcare innovation that were really largely caused by the pandemic, they've driven not only outsized profits for these companies that we talked about sort of in the top down, but they're also will translate into a source of efficiencies across corporations. And that can be mobile remote workforces or reduced office footprints. And then the ability, the spurring of advances in medicine has just sort of unimaginable potential. So the global economy is expected to grow about 5.5%, fastest post-recession pace in 80 years. But even as you look to 2022, economists are forecasting 4% GDP growth. So, any faltering of that growth, by the way, you have a situation where you're likely to see the central banks maintain their sort of accommodative posture. If the Delta variant were to derail the pace of reopening, the central banks have the tools, they're well sharpened, they've proven willing to act. And I believe that it's an environment where you want to participate in global equities in the long term, recognizing the potential risks for volatility and interim drawdowns. And while we can't time the markets, it's always a good time to put into place a sensible, diversified asset allocation strategy that would make Harry Markowitz proud. So thanks, I'll stop there.
Thanks, Mike. In fact, many of the questions that we have received from the viewers, you have covered many of them in terms of the high valuations, concerns, the global growth, etc. I'll begin by one question which has come from viewers. Is that first I will direct this to Navneet, then Mike can add on to it. Is why you mentioned that this is our first international offering and we have chosen to go on a passive strategy. So why have we chosen the passive route? And maybe Mike can add that this being a developed market index, so is there a case for passive investing more evident in a developed market as compared to emerging market? So Navneet, you can begin by answering that first part of the question.
So, thanks, Mike, for that wonderful exposition of the entire, what's happening in the global macro, about this fund, about developed markets, and you covered various points. And Ram, I think you've answered within your question that within the developed market, given the efficiency in those markets, the possibility of generating alpha is limited. And one of our mandates to Credit Suisse and this fund was that how can we get exposure to these markets in the most cost-effective manner? And we found the best possible way of doing it, the way we have structured this fund. You get a diversification, which is the country diversification, you get currency diversification, you get sector diversification, you get style diversification, which Mike talked about. You can see stocks which are the so-called growth stocks or value stocks. You get size diversification. You have, a lowest market cap company in this fund would be $1 billion company, and the largest would be like $2.5 trillion of companies like Apple. So you get size diversification and of course the currency diversification. With all of this, our belief is that, and I'm sure Mike can add a lot more, that I think passive is a better route to get this exposure, and we have tried to get it at the lowest possible cost. In fact, I would urge Mike to also touch upon how we focused on bringing down the cost and making it as effective for the investors by, you can give that example of taking exposure to US stock through the Irish structure so that you save some tax on the dividend income that you get from the US stocks. And then that will just explain how we have made it as cost effective as possible to reduce the overall impact cost and to generate best possible returns for the end investors.
I think that's a good point. Navneet, you and I know when we talk about the thought that went into the complex structuring of a seemingly fairly simple solution. It's kind of like, the analogy of the duck on the pond that looks like it's moving forward, but underneath, HDFC is paddling very hard. And so very thoughtful structure to ensure maximum efficiency, including addressing issues that are often overlooked, like things like tax withholding or any of the factors that may dilute performance. Fees, the lower the fees, that's straight alpha. And so with HDFC Asset Management, really driving is how do we create the most efficient solution for investors? And it does go also, we have plenty of actively oriented strategies, particularly within thematic equities. But I want to address the question, and it's largely aligned with what Navneet said, which is, for me, again, it's fairly straightforward, which is exactly what he said. The larger and more competitive the markets or an investment strategy, the less room there is to add value, and the harder it is for active managers to justify their fees. And I know the US numbers very well, so maybe I'll share them, which is that around 80% of active managers in the US, and keep in mind that's the largest proportion of this portfolio, underperform the S&P 500 net of fees. And even the ones that outperform, it's often driven by factor exposures. No one is a great market timer. You can have good stock selection, but there tends to be factor exposures or biases that can change over time that you don't have in a diversified passive solution. And in particular, when you get the lower fees, broad access, it's why I think the MSCI World is a good solution for developed markets. And as you said, to get all of that exposure in one investment on a cost-efficient liquid basis really makes sense. And to be fair, there are plenty of markets and sectors that are less efficient and offer opportunities for outperformance, like less developed markets. And I include India as one of these great inefficient markets suitable for active equities. I mentioned thematic equities similarly. So I think utilizing the MSCI World allows you to gain substantial portfolio diversification across global equities in that liquid, cost-effective manner, single investment. And it allows, I like your point about, you said time, but it allows investors the time to focus on selecting other investments that really reflect their views in these emerging markets or niche sectors or alternatives.
Thanks, Mike. Thanks, Navneet. Navneet, I just have a question for you. When it comes to international investing, for many Indian investors, it's going to be the first time as well. So given the nascent stage at which this segment of international investing as far as mutual fund market is concerned, so how much do you think an investor should invest in a fund like ours, like HDFC Developed World Index's fund of funds? So how much of the, say, overall asset allocation pie, how much should such a fund occupy?
So I think that we should leave it to our friends who are there on the call, who do the asset allocation and the risk profiling of each investor. I think that will differ from investor to investor. But I think anywhere between, depending on the each investor's risk appetite and what their rest of the portfolios are, I think anywhere between 5 to 20%. But whether in this fund or through some other means, I think some bit of global diversification would really make sense. I think within the global diversification, we strongly believe that this one fund provides you the best possible diversification at the least possible cost. So, for an Indian investor, where all your investments are in Indian equities, from an equity investment perspective, I think within this fund, you get the best possible the benefit of the best possible diversification. You don't have to really do the excessive diversification as far as international investing is concerned, because you are investing a very small portion of your overall investments. I remember early in my career, somebody said that for the great wealth is made by highly concentrated portfolios, but it cannot be done by everyone. Moderate wealth can be done by professional diversification, but the excessive diversification won't really give you the right results. And of course, the wealth is destroyed by excessive concentration or with neglect. So I think if you want a global diversification, I think this is one good solution to really look at.
So maybe Mike can add, because Mike, you are used to the interaction. You must be interacting with the investors across the world. Within India, we have always been used to receiving foreign capital, and it's a new trend over the last few years that we are starting to invest abroad. But what is the experience for, say, typical US investor or any from any developed? How do they look at when it comes to global investing? What is the approach?
Yeah. So I think if you look at that traditional model, which I mentioned, which is it's 60% equities, and developed markets would make up the largest proportion of that. So some capturing of these same underlying exposures. It may not be the MSCI World, but there's a reason I think the MSCI World Global allocation, maybe $60 trillion, is that it allows you to gain that efficient broad access versus going country by country, manager by manager. So even though people may gain that exposure in different ways, this is typically the largest portion of an investor's portfolio on a global basis. However, I would make Chair Navneet's point, which is higher allocation is not suitable for everyone. It has to be premised on your risk tolerance so that you can be a durable long-term investor. And that's what ensures that you get the benefit of this diversification. If you're trying to time the market, like, oh, markets are a little bit elevated now, I'll wait for a pullback. Really what ends up happening is when markets run up further, you tend to chase. And then when they retract, you tend to redeem. And that's sort of the ultimate way to destroy the long-term benefit of this compounding. So if you look at things like a target date fund, which is as you get older and as you look towards, let's say, retirement, you want to be less in equities. But if you're sort of in the middle of your investment career and in your life and you want to compound and grow over time, you should have a larger allocation to equity. And I think particularly as wonderful of an investment destination that India is, similarly to China, there is that idiosyncratic risk. And I think you benefit by a fairly sizable investment outside of India. How you choose to gain that exposure obviously is specific to each investor.
Thanks, Mike. A lot of viewers have asked about US centric questions. I mean, we know that MSCI World accounts for 67% of the index is accounted for by the US exposure. And there are questions related to these FANG stocks, as they are popularly called. It's typically they have delivered strong returns in the past few years on the back of healthy growth. Do you expect, Mike, this trend to continue, and how this will impact a more diversified index like MSCI World? I mean, the US has been a key component for the last 10 years, great performance of MSCI World Index. If that trend continues, will this be a better strategy to diversify across the globe, or one should look at US specific? How does it compare versus a US specific fund?
Yeah. Well, it's obviously people focus on FANG and the names of the companies. I focus on earnings growth. And we are going through what some people call the fourth industrial revolution. And I'm not trying to tout technology over other sectors, but this period of innovation has translated why it's so different from 99. Actually, maybe I'll step back. Is 99, you had hopeful expectations that drove market caps higher, that created a bubble that could be popped. And some of these names may have been there, but they weren't substantiated with earnings power. Now, when you look at Warren Buffett's allocation to Apple, it was as a value investment. These stocks are full of cash, plus they can borrow really cheaply. They have immense growth rates at scale, I would say, that we've never seen in history. And so they are supporting the market caps based on fundamentals, which is earnings growth. And how sustainable that is, or what the value is relative to future growth, is what the market adjusts to continuously. And as much as you say you have a concentration here today, that's really what you want in an index, which is you want to ride the winners and cut the losers. And that's done inherently in a market cap weighted index. So if those companies, and I'm not seeking to predict whether or not they'll go up or how much they'll go up, but first of all, if the fundamentals continue, there's very strong support. And so most of those companies, if not all, maybe Tesla, maybe the one exception, you have really strong fundamental drivers that will sustain reasonable performance. And if there's a rotation, like I said, I think healthcare and innovative medicine may represent that, then those will pick up support as you have some laggards. So it's just, what are the market leaders? And so I would almost go the opposite, which is, for instance, the fact that we've had massive sectors like consumer non-discretionary, like travel and leisure, or consumer discretionary has done very well. Obviously, we've seen purchase of technology, but all of these sectors that have underperformed actually are the spring-loaded performance for MSCI World. So I think less about the dependence as much as that I have a lot of other opportunities to support the performance of these indices, including the countries that I mentioned, which have massive monetary stimulus. So it's almost the opposite. We've gotten the benefit of those companies. I expect they'll continue to do well, but there's a lot of sort of potential energy in the portfolio that MSCI World offers.
Thanks,
And
Mike.
Ram, I mean, if you compare with Nifty and the sector exposure of this index, as I showed earlier, that the largest weight is in IT, information technology, at 22.5%. Next is financials, which is 13%, and compare that with Indian markets. Healthcare is 12.8, which I just talked about, and then you have industrials at 10.5%, consumer discretionary around like 12%, communication services 9%. So a lot more diversified. And the 2 or 3 things that Mike talked about, that we have seen an extraordinary monetary stimulus supplemented by fiscal stimulus, growth enhancing policies, and the innovation, which has accelerated, particularly post-COVID. If over the next few years, we see a more broad-based global growth, then this is a better way of capturing that growth than a very narrow set of stocks which have done extraordinarily well. In a world where growth was scarce and so much of money was chasing few of the stocks which were delivering well, and for variety of other reasons, including the more and more money into the passive strategies or into ESG, algo trading, all of these just, and the Robinhood effect, all of that accelerated that momentum. If the growth is going to be more broad-based over the next several years, then this polarization should reverse, and this is a better way of capturing it.
Thanks, Navneet. While we are touching about 1 hour since we started, I'll try and squeeze a couple of more questions. One for Mike. So Mike, so this fund obviously has a currency impact. When an investor invests in this fund, there is this impact of the currency. So historically, while the Indian currency has depreciated against most developed market currencies, now whenever the currency view is asked, we typically say that we are not currency experts because there are so many factors involved. But if I ask you to cover a little bit of the view on USD as compared to other currencies, and also if you can touch upon, if you can also touch upon a little bit on the Indian currency as well as compared to various other currency. I'm sure that's a maybe an unfair ask, but if you can cover that, it would be great.
Well, I think they're very difficult, complex questions from a macroeconomic perspective to foresee currency trends. I don't think I would be qualified to comment on India per se, but I think the interesting thing in a global economy is that there's an effect of a lower currency or weaker currency, which if you're translating it into your local currency would have a negative impact. That is very favorable for exports. And so we were talking about the concentration in, or let's say the largest denomination in the US of MSCI World. Well, over 30% of the revenue of the S&P 500 companies are derived globally. So that portion, if the dollar were to weaken, I think it's very difficult to say if that's the case, then you have the benefit of increased exports. And so there's an adjustive mechanism. I would say, betting on a specific currency is difficult. And again, that's one of the best things. When people think about investing globally or offshore, they tend to be really dollar based, whereas there's benefits to gaining diversification to some of the other countries. So things like monetary policy will be drivers of currency exchanges. I think in the case of India, you also have current account deficits and fiscal deficits that weigh in, whether or not there's imports of gold or the price of oil. So there are a lot of unforeseen factors. But what I would say is that over time, investors in India will likely benefit from the currency appreciation relative to the rupee in this type of investment. So you may get a double benefit, which is the investment diversification, the investment in non-rupee assets, and then coming back. So I think it's a great question. It's a tough one to answer. And because we don't have a great answer, diversification is the appropriate solution.
Thanks, Mike. Finally, Navneet, just one question. When it comes to international investing, typically in India, most Indian investors have been using traditional savings method when it comes to investing. Slowly, there has been a shift towards smarter products like mutual funds and other financial savings venues. When it comes to investing internationally, there is this, you are getting into the unfamiliar territory. There is this element of discomfort. Oh, we don't know what's happening. India itself is a complex place to analyze, etc. So this is, your money is going outside India. So what is your advice or suggestion for people to come out of that discomfort?
So I can relate it to our ongoing investor education campaign that I talked before, Barni Se Azadi, where we focus on the need of people to come out of the comfort zone when it comes to investing, from traditional savings method to investing in mutual funds. And when it comes to international investing, there's again a need for investors to come out of the comfort zone of domestic markets, because many investors may say that why invest outside India where we are not familiar with, but this provides diversification, which is what Mike and I have been highlighting over the last 1 hour or so, that you get the benefit of diversification. As I mentioned, in the broadest possible sense, I mean, a country diversification, a sector diversification, currency diversification, style diversification, I mean, so on and so forth. And you get returns, I mean, as the history clearly shows, returns with much, much lower volatility and lower correlation with the Indian market. So that's the justification for this fund.
Thanks, Navneet. In terms of
Ram, if I can ask one question to Mike, if you permit. Mike, growth investing has outperformed value investing for a longest period of time in the history of last 50 years. And I suppose the divergence is at its maximum. Somewhere people believe that some kind of convergence should take place. So in your opinion, what are the factors which could lead to convergence between this growth investing and value investing? So what are the factors which can drive re-rating of value stocks for that matter?
Well, I think you're right in that there's inevitably an element of mean reversion, right? Growth can't become more expensive and value cheaper without some adjustment, because the economic factors as value-based stocks build cash stockpiles, grow earnings, multiples inevitably compress, and they get to a level that's so compelling. And if they don't get there by market forces, things like stock buybacks, which have been increasingly popularized in the current markets, come into play. Then you start to see M&A of the growth companies relative to traditional companies. So maybe you take like an Amazon buying Whole Foods. So grocery business is one of the lowest margin businesses. Once those become value stocks, they become integrated into the larger companies and become acquisition targets, or you start to see roll-ups. So there are economic forces that ensure that over time you will have a mean reversion. Now, this has been an unusual period, not only over the last 10 years, but on a more accelerated basis in the last 18 months. But if you look at, let's say, JP Morgan, where you have incredible performance, it's part of MSCI World, they're starting to say, we are a technology company. So they're incorporating these growth drivers and gaining economic efficiencies from the utilization of technology. And that's going to drive increased productivity and increased margins and growth, coupled with the fact that when these companies can borrow cheaply and invest in high ROE CapEx, that's going to further propel growth. So there's sort of inherent mean reversion or normalization that means that I guess I maybe sidetrack, but we as humans tend to extrapolate recent history indefinitely into the future. So we say, wow, 10 years about performance of growth, all I should do is invest in growth and not value. And just when everyone makes that shift is when value really matters. And we saw that in the first half of this year. And Warren Buffett has done just fine sticking to this methodology. So I think it's really important that you have the benefit of both.
Thanks, Mike.
Thanks, Mike. I think I have tried to ask as many questions as possible from a topics or a subject point of view. There are many questions that I couldn't ask. We are well past time. So with that, I request Navneet to give the final remarks, and then we can end the session.
So as we have mentioned that the fund has the potential to offer diversified returns across different markets, which have low correlation with the domestic markets, and is definitely suitable for investors looking for a diversified fund that invests and participates in the growth prospects of the developed markets. And I want to thank each and every one of you for your unending support to us. And I sincerely hope that people would be able to take benefit of by investing in this fund, the benefit of global diversification. Thanks for your support, and then we are available for any more questions later on through email or other sources.
Thank you, everyone, and thanks, Mike, for joining on this call. Thanks, Navneet. Thanks, Ashok. With that, we can end the call.
And Ashish.
Thanks,
you.
Ashish.
And thank you, Ashish.
Thank you all.
Have a good day. Bye.
Bye-bye.
Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.